Convergence of TradFi and Digital Asset Markets, a Maturing Ecosystem. The institutionalization of digital assets and its convergence with traditional financial systems is not a passing trend, but a structural realignment of markets, says Hunting Hill Global Capital's Adam Guren. You're reading Crypto Long and Short, our weekly newsletter featuring insights, news, and analysis for the professional investor. Sign up here to get it in your inbox every Wednesday. The line between traditional and crypto markets is actively being redrawn. As digital asset markets mature, the convergence of traditional finance, TradFi, and digital markets is accelerating, resulting in a more mature, institutional-grade ecosystem shaped by the frameworks, expectations, and operational resilience that have historically characterized TradFi. Recent developments underscore a paradigm shift in how digital assets are perceived by institutions. The U.S. government's announcement of a strategic digital asset reserve, consisting of Bitcoin, Ether, XRP, Solana, and Cardano, signals strong institutional validation. In parallel, more than 11 U.S. states have shown interest in or are actively working on Bitcoin treasury bills. Sovereign investors such as the Abu Dhabi Investment Authority, ADIA, have disclosed significant positions, with a $436.9 million stake in BlackRock's iShares Bitcoin ETF, IBIT, as of December 31, 2024. These aren't speculative moves, but rather concerted investments to stay at the forefront of an evolving financial system. Support from these governments is reinforcing institutional engagement, marking a turning point where the risk of missing out outweighs the risk of exposure to the digital assets ecosystem. Previously, institutional participation in digital assets was constrained by high volatility, regulatory uncertainty, and fragmented infrastructure. Now, regulated custodians offer institutional-grade solutions, while trading platforms provide improved access and reliable execution. The expansion of risk management tools, including hedging, credit facilities, and market surveillance, has enhanced the operational stability for a space once known for volatility. These developments have lowered barriers to entry, enabling traditional institutions to approach digital assets with familiar risk and compliance frameworks. Institutional adoption is further fueled by products that mirror traditional markets while leveraging blockchain advantages. Today's institutional offerings include spot and derivatives markets, yield-bearing products, ETFs, and in-kind redemptions and depository receipts, all designed with similar underwriting logic and performance expectations. The expansion of futures, options, and structured products in crypto mirrors the mechanics of TradFi derivatives. These instruments provide price discovery, risk hedging, and speculative capabilities that align with institutional mandates. Yield-bearing products like staking, crypto lending, and tokenized fixed income are being designed with yield profiles resembling TradFi. These structures provide fixed or floating returns while incorporating risk metrics familiar to institutions. One of the most popular products has been spot Bitcoin ETPs. Nasdaq's proposed in-kind redemptions for BlackRock's Bitcoin ETF further align crypto ETFs with traditional counterparts, boosting efficiency and liquidity. Additionally, crypto depository receipts enable institutions to access digital assets without direct custody, bridging traditional markets and crypto in a regulated, familiar structure. Institutional investors are engaging through structures that blend traditional and digital techniques. Hybrid funds, separately managed accounts, SMAs, and bespoke mandates. These tailor exposure while maintaining operational familiarity, providing institutions with regulated pathways to participate in this evolving ecosystem. Regulatory clarity remains critical. Recent SEC moves and a more crypto-forward administration signal openness to clearer frameworks, encouraging increased institutional engagement. Some traditional players are still taking a wait-and-see approach, cautiously observing market infrastructure and regulatory signals before committing capital at scale. On the other hand, firms like BlackRock, Fidelity, and Citadel are entering the DeFi space. Institutional adoption is unlocking portfolio diversification, enhanced market efficiency, and a more structured approach to risk management, all pointing to a more robust financial ecosystem. The institutionalization of digital assets and its convergence with traditional financial systems is not a passing trend, but a structural realignment of markets. Forward-looking institutions are not just participating, they're supporting the emerging ecosystem. For CIOs and allocators, this convergence presents an inflection point. The ability to navigate digital assets with TradFi discipline and DeFi innovation is becoming a key differentiator, placing emphasis on the importance of partnering with firms who have deep experience across both markets. As the financial landscape evolves, institutions that stay informed and insightful will find themselves positioned to adapt and thrive. Adam Guren is founder and CIO of Hunting Hill Global Capital, which launched its first fund in February 2012, and also serves as chairman of Hunting Hill Digital, the digital asset management affiliate launched in 2022. Adam has over a decade of experience in portfolio management, trade execution, and risk management across both traditional and digital asset markets. He has held senior roles at prominent institutions such as First New York Securities, where he managed a global event-driven arbitrage portfolio and became a partner at the age of 26, the youngest partner in the firm's history at that time.